Hey there, everyone. Happy Wednesday, June 17th. Welcome to Chart This with Dave Keller. I'm your host, Dave Keller, coming to you from a beautifully cool and comfortable June day here in Redmond, Washington. Hope you guys are all doing well. I had to peel myself away from watching England, Croatia. Not everyone's into the World Cup, and I can respect that. Our family very much is, and it is brutal that it is in our comfortable time zone here in the Americas because there's soccer, at least for us, from around 10 a.m. Pacific through the early evening, and it's just awesome. So not watching those games is the biggest challenge that I have. I actually have a TV right here, but it's off. I would rotate the camera to prove it, but trust me on this one. I am taking a break, but I'm a huge Harry Kane fan because I followed Tottenham for many, many years and loved watching Harry Kane. Once he left, it got less fun for me, but it was awesome to see him score a header off the set piece earlier. Not a great day for stocks. Not a great initial meeting for new Fed Chair Kevin Warsh, one would argue, in terms of the market's reaction. Now, this is not necessarily Warsh's fault, but certainly the market taking the afternoon as a risk-off sort of play. No real change in terms of policy from the Fed meeting yesterday and today, but as the press conference continued, as the market digested what they learned, as you assess the dot plot about expectations of Fed governors and future Fed policy, certainly implies rate hikes are coming. Most of them suggesting at least one hike, a number of them suggesting at least two rate hikes. And so, it certainly looks like that's the general trajectory here. And so that tells you a little bit about the environment that we're in. And of course, and once that starts to be priced in, the market of course, starting to rotate lower, sort of a sideways treading water market until that press conference began. And that's when things started to rotate lower. So here's the plan now. Now that Fed meeting is behind us and the market more and more having to acknowledge and accept the fact that rate hikes are coming, again, in reaction to inflationary pressures that seem not so transitory and certainly pretty elevated. We are now left with the additional data. We've got triple witching tomorrow. Friday, of course, the market's closed for the Juneteenth holiday here in the U.S., which means Thursday's the end of the week. That's when will be the options expiration for June. And then we have the whatever this signed press thing that is definitely not an agreement, but maybe something coming on Friday. We'll see. I remain skeptical, just given the number of times we've heard there's an agreement that's going to be great, the best we've ever seen, but we haven't seen it yet. We'll see what happens. Thanks so much for tuning in live. Those of you on Facebook, LinkedIn, YouTube, and X. By the way, I had a bunch of fun with the folks on IBD Live. We laugh a ton when we're doing those things. They're just such the friendliest, nicest group of people I've ever worked with, I feel like. And so it's a lot of fun to talk charts with guys like Mike Webster and Justin Nielsen and Allie, the host, and Ken and others that were all on the call this morning. Ton of fun. So if you are an IBD follower, I do get on there pretty randomly, and I'll try to let you know. I think I completely blanked on letting people know I was going to be on there. And that was my bad. I just had other things going on, but it was a lot of fun. If you tuned in, hope you enjoyed it. It was great to talk charts. All right, enough intro. Let's talk about what happened to the market. So this market, of course, evolved very quickly after the Fed meeting at 2 p.m. Eastern time. That is, there's the Fed announcement at 2 p.m. The market kind of came off pretty quickly during that as the press conference started. And that's kind of right around here on the little chart. You can see how things rolled over to finish near the lows of the day. The S&P down 1.2% to 7420. The Nasdaq Composite down 1.33%, and that's leading the way lower. The Dow down as well 1%. I think that was a noticeable sort of feature of today's market in particular, is the fact that all the benchmarks were down, right? Large caps, small caps, growthy stuff, value stuff, kind of everything rotated lower in the afternoon is when things really started to accelerate. All 11 of the S&P sectors finished in the red. I was pretty sure that happened. I had to glance over there to confirm it, but it sure was. Volatility accelerated to the upside. We sort of, around the Fed meeting kickoff, it was just below 17, quickly spiked up into the 17s and then eventually into the 18s. to finish around 18.4. So not quite above our red line at 20, but certainly increasing here, right? Yesterday, we were down in the mid 15s, around 16 at the close. So we're seeing an increase in the VIX, which basically means the options market pricing in some bigger swings here. I think that's a reasonable expectation given some of the news flow we can anticipate here over the next couple of days. Looking at the bond markets, you can see bonds actually generally sold off as the press conference was going. You can see the TLT actually finished slightly higher, but rates were generally higher as well. So the 10-year Treasury yield finished around 4.46. The long bond yield was basically flat around 4.9%, 4.93 we'll call it. And the dollar, one of the biggest moves as well. Dollar surging higher in the afternoon. And the dollar index, which I'll show you in a little bit, pushing right back up toward that 100 level, that parity level that we've often talked about. That's where the dollar index has often hit a resistance over the last 6 to 8 months. We'll show you the chart and show you why today's move could signal the beginning of a change in that. Dollar spikes above 100. I think that would be a real issue here for risk assets. Looking at the commodity space, gold down, silver down, copper down, crude oil down, natural gas down, the energy and the precious metals areas of the commodity space all feeling the pain here. Gold remains below the 200-day moving average. And in my head, when I'm saying that, I'm thinking of the chart of the GLD, which is what I personally own and what I've usually made plays in, either that or the IAU. And both of those down today. This is gold futures we're looking at, finishing just about 42.56. Silver price is down about 3% as well, as was copper. Crude oil price is down, but not a ton. They actually were drifting higher earlier in the day, but as equities rolled over going into the equity market close, the crude oil benchmarks rolled over as well as the natural gas prices. Only positive signs generally in the commodity space were in the soft commodities. The grains like soybean, corn, and wheat, which all of those have been pulling back here pretty good in June, but a bit of a bounce higher. Wheat stands out to me as one of those charts that may be interesting. I think I grabbed that chart to review in a little bit, actually. Cryptocurrencies were looking great until the afternoon hit. In the afternoon Eastern time, Bitcoin, Ethereum, and the rest of the top 10 coins all rolled over to finish to currently be trading pretty weaker. Bitcoin is around 64,300. Ether price is just below 1750. All right, looking at the 11 S&P sectors, this got worse and worse as the day progressed, particularly in the afternoon. It's pretty okay. I think it was sort of a coin flip midday, and then the afternoon, everything started to get dragged down. Worst performers today on a down day for stocks. Communication services, real estate, consumer discretionary, consumer staples, all down over 2%. And communication services, again, just I think a layup for the worst relative strength on a sector basis here in the second quarter. Far underwhelming. I mean, just underperforming everything in the last 10 weeks or so. On the upside, or at least on the least downside, at the top of the list, you have industrials, technology, financials. Financials are down about 0.5%. Tech and industrials a little bit less than that. So what's interesting is those sectors at the top, industrials, technology, and financials, when I'm scanning for ideas, I'm finding a lot of ideas in a lot of different sectors, to be honest with you, in terms of interesting charts worth paying attention to. But the concentration of great charts I'm finding personally are in industrials, things like some of the industrial like machinery names. I don't know if I grabbed any of those. We talked about them on IBD Live this morning. Caterpillar came up with some of the other machinery names as well. Technology, of course, like the storage names like Seagate and Western Digital stand out. Financials, a lot of the banks like Goldman, Morgan Stanley, and others have all had pretty good charts. So I'm not surprised to see those down the least in a day like today. But let's be clear, today was a risk-off day. The breadth got worse and worse as the afternoon went on, and we had a really good discussion earlier, which I'll recap briefly here in a short while with Vince Randazzo and Ryan Gorman, portfolio managers of the new technical analysis driven ETF, and we talked a lot about their process. Breadth is a core part of it, so we talked a lot about breadth earlier today. So very interesting that on today, after the Fed meeting, breadth really started to rotate lower. A lot of those breadth indicators are still pretty good when you look at like the cumulative advanced decline lines. But today really shows you how much of a down day it was. And we rarely see the very bearish color because it just doesn't happen that often. Same with the very bullish. Here's what it looks like. It's kind of like a deeper pinkish red, kind of a salmon color, if you ask me. And then the deep, like dark reddish kind of almost blackish red numbers. So there you go. That's what that looks like. So on the S&P, really ugly breadth. And 86% down to 14% up. On the New York Composite Index, which is the main one that we follow, about a 3-to-1 ratio, 74% decliners there. About 80% of the small cap and mid cap indexes were down today. So to be clear, this is a broad distribution going into close. Nothing was immune from this. That's not true. There were some things that were actually up. And when we get to the heat map, a day like today is awesome to find very quickly the stocks that were not down today. That's always a really interesting list to pay attention to. But breadth today, pretty weak. I mentioned nothing was immune, and from value to growth, from large to small, everything kind of took it on the chin today. Small cap value ended up being the worst performing Morningstar style box, and mid cap growth ended up being the best. That's not true. Small cap growth, down 0.9%. Looking at the Magnificent Seven and friends, and speaking of stocks that were not down today, you're going to find a lot of those were in the technology sector. Broadcom was one that was actually up over 4% today. Meta Platforms down 5.4%. A bear market in SpaceX down 5%, and I say that with a great deal of cynicism and sarcasm. SpaceX is still pretty early on post IPO. And I think still sort of establishing an initial range just from the first couple of days of trading. But we're, it was not immune from the general risk off behavior today. And that's honestly the challenge. I think the biggest challenge for an IPO, there are a number of challenges. I mean, obviously just the general participation is one, but the environment within which an IPO goes public can be incredibly impactful on the success of that IPO in terms of the trajectory after it begins trading. Worst thing that can happen for SpaceX is if there's a big just kind of risk off move in the markets, less about SpaceX and its particular, value proposition as a company, but more just about the fact that investors are not looking to throw a lot of money at a lot of speculative AI kind of plays. That would be a challenge. Now, you're seeing plenty of AI names hold up okay today. So I think we're still all right, but that's certainly a risk. And so today, kind of being dragged down with everything else is the way I would think of it. All right, we'll get to the heat map next. As a reminder, we're live streaming on Facebook, LinkedIn, YouTube, and X, and I appreciate you guys. I see a lot of familiar names in the chat on YouTube and elsewhere, and it's great to have you join me. As always, please drop questions all along the way, and we'll try to grab a couple before the end of the episode. If you're watching the show later on our YouTube channel, please use the comment section for questions, and we appreciate it. And Tony, listen, thank you again with a very kind gesture on my YouTube channel with the super chat. I appreciate that so much. It's really, really kind of you, and I appreciate your kind words, any of you. If what I'm doing is helpful to you, that means a lot. If you're willing to throw some money behind it on YouTube, I really appreciate that as well. And that's very thoughtful and genuinely appreciate it. Thanks so much. All right, let us look at the heat map here. A lot of red going on. So what we're going to do, right? Obviously, a lot of things were down. So let's focus on the areas of the market that were not down, because a lot of things just kind of got dragged down, right? I was taught a rising tide lifts all boats, and now we're seeing a sinking, a falling tide sinks boats. That's not the really great metaphor, but that's the idea, right? I mean, it works both ways, unfortunately. So if investors are just not looking to buy a lot of stocks generally are going to start to lighten up. But you can see there's some pockets of green, and some of those are concentrated, I would argue, in just a couple sectors. Number one, we have to start with the technology sector in the upper left. It's Applied Materials, it's Intel, it's Broadcom, Micron. These are a bunch of semiconductor names, LRCX. These have been some of the strongest charts in the case of like Lam Research and Micron and others. They are continuing to push new all-time highs. They are, I would say, from a technical perspective, still in a great structure of higher highs and higher lows. And the storage names, which are kind of tangentially related to that, AI infrastructure theme, both making new all-time highs today again. And I think both of those charts remain pretty great charts. Western Digital is one we've been focusing on recently, but I think they're both pretty powerful uptrends right about now. Other than that, random other names in the technology sector, but that's one particular group and a couple groups that stand out. Second would be the industrial sector, right? And look at Caterpillar making a new all-time high today. So again, while the market was pulling back a bit, Caterpillar made a new all-time high today. So that kind of classic industrial trade doing pretty well. Some aerospace defense names like GE Aerospace making a new all-time high today, up 1%, 1.5%. Raytheon, I did grab that chart to look at in a little bit. Nice kind of, pullback, obviously, in March and April, but then a consolidation and now a breakout. So we're seeing an improvement in RTX. We're seeing Howmet, HWM, which is a name we've talked about a while ago, making new all-time highs as well. So TDG is another one, really more of an earlier breakout, making a new 3-month high today. So I would say that aerospace defense theme, and then some of the classic kind of industrial names like Caterpillar, all working well today. And again, that I think is meaningful, right? Because if the narrative today is investors are going risk off and selling stocks, they weren't selling those. And so I think that tells you something. Final group would be financials. And this is a sector we focused on quite a bit on yesterday's episode. So if you missed our Tuesday show, please go back there because we talked about some of the banks, some of the asset managers, some of the other names and what they're doing. Robinhood, which we talked about, finished the day above $100 a share, up almost 9% today. Morgan Stanley and Goldman Sachs, two names that we've highlighted that have been in a primary uptrend, both making new all-time high new highs today. JP Morgan kind of right at that point, testing that January previous all-time peak. So the clusters, and again, it wasn't a ton of names that were up today in the S&P, but the three main buckets I'm finding them are in technology, a documented theme we've been covering, in industrial, some of those names like aerospace and some of the industrial, larger names, and then in the financial sector, kind of across the board, a number of different ones, particularly the larger banks that are doing pretty well here. Other than that, it's a smattering of random names and things like healthcare and materials. But other than that, this is pretty much a down day for stocks. And so day like today, I think, is a great reminder that there's, for me, my process has a top-down component where we look at the major indexes, where we look at breadth, where we look at sentiment, where we look at, market trends using our market trend model, where we think about how much do we want to be putting into the equity portion of a portfolio type of questions. But then there's also a bottom-up process. And that's why I'd say it's always a good time to own good charts. On a day like today, it becomes pretty clear what the good charts are because they're the ones that are actually doing pretty well. Generally, these are ones doing pretty well while everything else is kind of pulling back a bit. So if you're not in a lot of those names that are bright green that have pretty good charts making new highs still, while the S&P and the Nasdaq are not, that's where I would start to question the opportunity cost, right? The problems you have not owning some of those great charts, which could allow you to outperform right about now as the benchmarks are struggling a bit. All right, we'll continue on in a moment. As a reminder, we had a great live stream earlier today with Vince Randazzo and Ryan Gorman. These are two fellow CMTs that just launched a new ETF earlier this year called the Defender Risk Adaptive 500 ETF. I talked to a lot of them about their process. It's based on a bunch of research they've done on market regimes and regime change and trying to capture market upside and limit market downside. And I hope it was some great thoughts about how to think about risk, how to follow trends, but recognizing the importance of market breadth. The replay is available. It's on our YouTube channel. So if you're watching this here on our YouTube channel, look at the other videos and you'll see it there. It was a really good conversation from earlier today. I hope you will check it out. Thanks again to Vince and Ryan, two really smart market practitioners, and awesome to see people like that with some great experience and so much to bring to the table, getting the opportunity to run a fund and with some really good insights about how it could fit into a broader portfolio context. All right, let's finish off here looking at some charts together, shall we? Here's the daily chart of the S&P 500. We are continuing to kind of chop around here. And after yesterday's session, we're looking at this gap here. This is from like 74.60, we'll call it, to like 7,500, 7,510. That gap from Friday into Monday seemed like a pretty important gap, right? Because this was the pullback, and then all of a sudden we find a bit of a footing, and then we have this gap higher after the news over the weekend. Monday gap higher, Tuesday kind of remaining in the same range but closing at the lows. Today, of course, this afternoon with the rotation lower, we're kind of back within this consolidation phase. So I don't have this line extended, but I'm pretty much planning to do so. I mean, I think this level around 73.40 still pretty valuable. I think the 50-day moving average is going to be pretty essential as well. I might start bumping up this green, bullish range up there, but for now I'll keep it where it is. I still think we're in sort of a similar structure where we are now kind of consolidating up in this bullish range, kind of this green light area. Anything below like 71.20 would get us well out of this, bullish trajectory and feel much more like a meaningful pullback. So for now, I'm seeing this as chop within a primary uptrend, but I'm watching the 50-day. I'm watching that 73.40 level as sort of an initial line in the sand to pay attention to. The RSI, worth noting, almost exactly dead neutral today, 50.5. So the momentum is even. What that tells you is that the up and down days are fairly in balance. Buyers and sellers are in agreement. We're kind of just chopping around an equilibrium point. Breadth in this market in the month of June has gotten better and better. Of course, as today's session evolved into the afternoon, everything kind of selling off, keeping the breadth indicators that I follow still pretty good. But obviously having a pullback today, we are still over 50% of stocks in the S&P above their 50-day moving average. We're still well above 50% above their 200-day. So most stocks in the S&P have not broken that crucial initial level of support. The S&P, of course, has not broken it either. So that starts to happen, then I think you need to start to question, all right, is this the beginning of a bigger corrective move, and what do I do about it in my portfolio? But for now, still okay. I would say the breadth is still fairly constructive. One thing that has turned negative is the Chaikin money flow. The Chaikin money flow is a volume-based indicator. I haven't talked about it in a little while because the indicator's been just kind of pegged to the positive side for a while. This is an indicator created by Mark Chaikin. It's a way of looking back, the way that I'm using it, looking back at the last month and basically looking at the volume on up closes versus down closes. And it literally weights the daily volume reading based on where we close within the day's range. And it looks back at the last month. And the question this tries to answer is, what has been the general volume condition over the last month? And is it showing signs of accumulation, which is when it's above zero, or signs of distribution, which is when it's below zero? Now, we had highlighted how as the S&P was making a new high into the beginning of June, what concerned us was that the Chaikin money flow was going the wrong direction. Instead of volume showing more and more improvement, it was actually weakening because we were getting some down days along the way here. What's happened in the month of June, we can see that there's bigger red bars than black bars, which means on the down closes, there's been more heavy volume down days than heavy volume up days. And that has been enough to steadily deteriorate the indicator, which is now going net negative for the first time since the April low, or the March April low from the spring. So kind of a concerning breakdown in the volume condition. The negative volume we've been seeing in June is really starting to skew the indicator to the downside. This would tell you that the volume is more distributed in the way that we really haven't seen since the middle point in April. And so I think that's something to be a bit concerned about. Volatility still okay. And so, the VIX reminds me of breadth indicators. Like, the indicator's still okay. We're still below 20. We're still below a level where I think, this is a red flag we need to start to think about. We spiked higher from 16 up to 18 and a half, but not quite above there. VIX above 20 would be a concerning development for this market. For now, we're still safe. We did spike above the VIX back here in mid-June, and then it was alleviated. We'll see if we get another spike up there. Interesting to note, of course, here on Fed Day, as we digest the first meeting chaired by new Fed Chair Kevin Warsh, the fact that the 10-year Treasury yield for now appears to be finding support at its 50-day moving average. Here's the low in the 10-year Treasury yield. It's right around 442, 443, and that was from the end of last month, from the end of May. We've now bounced up and now retested that short-term level of support with the 10-year yield holding the 50-day. It's been above the 50-day moving average since early March. So is this the higher low before a resumption higher in the 10-year treasury yields possible, something we want to be keeping a wary eye out for sure. Here's the chart of the dollar. And I think the chart of the dollar kind of tells you the distribution or the negative trend that we saw in the dollar in the first half of 2025. And then what has been, I think, arguably been just the most sideways chart for the last year, right? If you look at where we're at right now, we're kind of at the same point we were in April of 2025. It's been over a year and we've been, trading below these levels, but essentially just keep coming back to the same point. What we've not really seen is a significant uptrend in the dollar breaking above that level. And this is 100 that I've highlighted in pink. You can see the recent tops over the last 9 or 10 months have all stalled out right above this level, exactly right about where we're at today. So I would say if there's any more upside in the dollar, this chart starts to change. We haven't been in a real strong dollar environment for a while, and that shift could have a lot of ripple effects on a lot of things like commodities, like rates, et cetera, et cetera. So stronger dollar could be a risk here. Stronger dollar often coincides with weaker gold prices, although that's not necessarily always the case. But I would say the trend in gold clearly lower. I do still have a position in GLD, but it's a much smaller position than I've had before, simply because we're in a downtrend and because gold's underperforming and it's now back below the 200-day moving average. Nothing would make me happier than to break back above 410 on the GLD. That would mean we're back above trendline resistance. That would mean we're back above the 200-day moving average. But until then, I don't see a lot of reason to add to that position. Combine that with everything I just said with the fact that the momentum turned negative in March and then now has remained almost entirely below 50. So that downtrend in gold appears to be, holding and appears to be in pretty decent shape here. Wheat, soybean, and corn all were pretty interesting charts back in like the beginning of the second quarter, but all of them rolled over in May into June. And so now we can see that the chart of the Tucurium Wheat Fund, which is ticker WEAT, it's an ETF that gives you exposure to wheat. You can see it's bouncing off of support here just below 22. That actually lines up pretty well with the swing low in April, and it also represents a 61.8% retracement of the 2026 rally. So interesting that we have kind of a confluence of support just above the 200-day moving average. This week, we appear to be bouncing off of that level of support. Would love to see it follow through above the 50-day and kind of regain that kind of 23.50 level, which would be kind of important. It's a little early on a bounce in the soft commodities, but the chart of wheat certainly stands out. And again, anything that's up on a day like today, I pay a little bit more attention to. So soybeans, corn, wheat, other soft commodities all doing well. Just to update on SpaceX, and again, I did not play this directly, but I do own things like the ARK Innovation Fund, ARKK, and I pretty much assumed that there would be a SpaceX position in there. Certainly there is, not surprisingly. So I do have exposure through an ETF or two, but for now, SpaceX, as a technical analyst, I would say there's limited data here. So for now, the way I think of it, we're still gathering information, trying to establish that initial range. And I would say for now, we've got a temporary ceiling around 220. We've got a temporary low around 150. That's kind of your initial framework from the first couple of days of trading. Now it's all about where we trade within these levels and at what point, especially after the initial pullback, do you start to see buyers come in. We've had a couple kind of brief bounces, during the day yesterday and today, but basically have been met by selling. And what was interesting about SpaceX is as everything else kind of rolled over in the afternoon, SpaceX not immune from that. And again, that's the concern on an IPO like that is if investors it's not about they're nervous about SpaceX. They're just not looking to put a lot of money at risk. That's what can really hurt an IPO, which is why, the bankers try so hard to find the right time when they feel like the market's going to be really excited about it and be willing to put money at risk. So that's a concern there. All right, let's look at some of the individual stocks that I've grabbed here. Fox Corp is one we highlighted. This is a really good chart up until the second week in June, and we can see this gap lower. Fox, of course, is tied to the buyout of who was it? Roku, I want to say, right? That sounds right. Fox and Roku. I'm pretty sure that's true. Yeah, right. Here's the spike up in Roku. So, the market basically saying that's great for Roku. and not great for Fox because we can see the gap lower. And what concerns me here is post gap down. The question is, do you see buyers coming in, right? And that often happens, right? You'd have a big gap down as the initial reaction is like bad for Fox, but then a bunch of people come in and say, well, hold on, we're now testing the February lows. Hold on, what's the valuation on the stock now? This is super cheap. And again, the market is not saying those things, as is evidenced by the fact that the next 2 days, that was Monday's gap lower after the news hit over the weekend. Now Tuesday and now Wednesday continue to drift lower. So it's oversold, but that can often happen at the beginning of a big deterioration, right? Here's when it was oversold at the beginning of February, and look how much further it got until it eventually came out of that oversold region. So being oversold on its own is not a great sign for me. Coming out of that oversold region could be interesting. For me, generally, falling knives are not my game. But if I was a mean reversion trader looking to buy some serious weakness, this is the kind of chart I might keep an eye on to see if we get a rotation higher. But for now, I would say the market definitely going, saying thumbs down on the implications for Fox. I mentioned the impressive, moves in some of the industrial names when we were looking at the heat map earlier. Raytheon, ticker RTX, comes to mind, making a new swing high today, back above the 200-day. And look at what happened here in April. We went below the 200-day, then we kind of hugged it from below, which is super uncommon. That is not a common, behavior you will find in the technical literature. However, it did it. And then it finally broke back above there. The RSI is pushing above 60 today, which I think is a really good sign of new accumulation. So good chart there. Other charts that look good. I mean, hey, listen, I still think that charts like STX are great charts. They're exceptionally good charts. Even if you're nervous about the markets, the way I sign off the show is it's always a good time to own good charts. So I'm a big fan of still owning names. If you have exposure, I don't see a macro issue as a reason to sell an individual stock. And that's why charts like STX, I think, are innocent until proven guilty. They still keep making new highs, which is why I still think they're good charts. All right. Let's grab a question or two. Let's see. I saw some comments about the head and shoulders pattern. Yeah, and thanks a number of you guys for weighing in on this one. I'll take a stab at it. Is a head and shoulders forming on the S&P? What a great question. So yeah, I mean, is this a head and shoulders pattern? So there is a great book I would point you to called How We Know What Isn't So. And there are a number of other books, but that's my favorite on this topic and I will summarize one of the takeaways, but you should still get the book because it was really interesting and thought-provoking. I love books that make me think. And this one was definitely one of them. It's all about, how we are designed to find patterns. And so we often find patterns when they aren't there. And this is a part of the technical toolkit that is often way more subjective than I think you probably want. Things like head and shoulders patterns and triangle patterns and things like that are visual patterns, right? They're shapes that emerge on the chart. So they can be very subjective. One, it might look like a pattern to you, but then I look at the same thing. I'm like, no, that's not it. And so I think one of the things you have to remember is if you go to the literature where these patterns were really dissected and presented and thoroughly described, and the one that comes to mind would be the Edwards and McGee classic book, Technical Analysis of Stock Trends. I should know the name of that book. I'm pretty sure that's it. If you go to my website, marketmisbehavior.com, click on the reading list because I'm pretty sure I have it on here. Yep. If you go down here to technical analysis tools and techniques, it's this one right here. I mean, this is, some would call it the Bible of technical analysis. It's called Technical Analysis of Stock Trends by Robert Edwards and John McGee. And these are legendary chartists and money managers who use charts, researchers who use charts, and literally wrote the book on price patterns. And they talk a lot about how it's not just, I see a pattern, oh, that's a head and shoulders. There's some rigor you have to apply to it. And so they would talk about the duration of the pattern. They would talk about the symmetry of the pattern. They would talk about the volume, which we usually ignore, and I'm probably guilty of that as well, but also about the neckline. And that's what I would tell you here. For a head and shoulders pattern to be a head and shoulders pattern, you need a high surrounded by lower highs, which I think we generally have. So that checks that box. you ideally want symmetry, right? So a head and shoulders pattern, the left and the right halves of the pattern should look pretty similar. That was kind of part of it. So if you like fold this piece of paper and fold the right half over the left half, they should line up pretty well. That we don't really have here, right? Because there's kind of this weird mix, this asymmetry where there's this gap and then the rollover now versus this, which is kind of a classic peak and valley. So I don't know if that's really good. And also this low looks nothing like this low, right? So we got a problem there. The third thing is the neckline. So I'm not labeling this a head and shoulders pattern. I'm drawing my own line over here just because I think that's a good way to look at it. But if I was, on the CMT exam and kind of grading this, the neckline has to be formed by the swing low between the head and the left shoulder, which is here, and the swing low between the head and the right shoulder, which is there. So your neckline is way the hell down here, which means until and unless you get all the way down to that point, you can't actually call it a head and shoulders pattern. So what a lot of people do is they just ignore it and they draw something like this and they say it's a head and shoulders pattern. That is called fake technical analysis. That is not actually the way it works, because we can't ignore price action to make our narrative or our pattern more convenient to be labeled. That is kind of a rookie mistake that we find people making when they're learning technical analysis. We want to get to a more systematic, disciplined way of applying things. And I think if you're applying, that sort of analysis, the way to make it more systematic is to understand those rules and really follow them. So I don't mean to belittle your question. I think your question is valid, and I think you're articulating what a lot of people probably are seeing on this pattern, which it looks a lot like head and shoulders. But when you actually go through that analysis, I would say it's not actually a great example of that. So I don't think thinking of it as a pattern that way makes a ton of sense. So how do we think about it? It's kind of how I'm labeling it, is how I'm thinking of it. I'm thinking of this low around 73.40 as the higher low within an uptrend. And then we made a new all-time high. But then we pulled back and we slightly undercut that level, but we never kind of followed through below it. So I think for me, this just kind of validates that 73.40 is a pretty important level. So if we keep going down here and we keep seeing buyers coming in and rotating higher, that just further validates that support. But if we close below there and then follow through, I think every time we test that level of support, that would make a future breakdown more painful and probably more significant to the downside. Great question there, by the way, and thanks so much for giving me an opportunity to kind of soapbox moment on price patterns and what they mean. But I hope that made sense for you, folks. Thank you so much. I did see some questions I didn't have a chance to get to, but I will add them to the mailbag. We're planning an all mailbag episode on Friday. Markets open tomorrow. It's triple witching day, so make sure you tune in. We'll do a brief on what happened there on Thursday. Friday, markets closed. We are still planning to have an episode to answer some of your great questions from the mailbag. In the meantime, go USA. Enjoy the World Cup. Enjoy your evening. We'll be back tomorrow. I'm Dave Keller reminding you it's always a good time to own good charts. Take care, folks.